Welcome everybody to a Martinis with Scott. Hope everybody's having a great Monday. Today we're going to talk about tips for you to think about for a process to attract a bank loan or debt financing to your business. Now, why are we going to talk about process? Why do you need these tips? Because in deals, in any corporate finance deal, M&A, financing, restructuring, whatever it is, momentum is key. And for there to be momentum, you have to have thought through the entire process and what you're going to do and the tools that you're going to need to make this transaction happen. So this will help you with your bank financing or other debt financing. So the first thing to do in terms of thinking about your deal is you need to think like a lender. And you need to understand the products that are available that different lenders provide for businesses. So, for example, you want to segregate your deal size. So, if you're trying to if you're trying to borrow $1 million in a operating line or first secured loan, it doesn't make any sense to go to somebody who has a minimum deal size of $10 million, right? And that's how lenders on deal size segregate themselves. So you need to have your list of lenders, and you need to look through, see what deal size they do. Will they do 0 to $1 million or 0 to 500,000? Will they do a $5 million deal, or is that too small? Will they do a $10 million deal, or is that too big? Right? And so it just depends on where you are, what your business is, and what lenders you're talking to. But you need to understand what a lender is doing. They're offering you a product and it fits within a certain box, and you need to understand what those boxes are. Deal type. So is it an operating loan from a bank? Is it an asset-based loan? And someday we'll do a Martinis with Scott on the details of asset-based lending. Actually, I should get a guest in for that. And we did some last season with small ABL / factoring people, First Vancouver Finance and Accord Financial in particular. So you can go look those up. And maybe what we'll do is we'll redo those shows and get into some more depth and some different topics. Anyways, operating loan, ABL. Do you want a term loan? Are you trying to buy new capital equipment? So you have a CapEx program, you need to borrow a term loan or a lease on that, right? So you need to understand, because lenders do different things. They're offering you a product, and so you need to understand what it is that you need. What security are you offering? Is it to an operating lender? You need to offer them receivables and inventory. It's what's called a revolving loan. Same on ABL, but you can add in equipment. Term loan is obviously equipment. A mortgage lender would be real estate. Understand the security, because that's what fits within the lender's box, as we talked about. Cash flow. Understand your cash flow, which means you have to have a financial projection to do that, and you're looking at debt service coverage, which means, do you have enough free cash every year or on a rolling quarterly basis? Do you have enough free cash coming out of this business to pay principal and interest plus a little bit extra room for things going wrong? That's your debt service coverage. And lenders, again, are looking for deals that fit within their parameters that they're comfortable with. Personal guarantees. Does this bank want a personal guarantee? Not want a personal guarantee? And so just know where will you provide one, right? And if you do provide one, is it limited? Do you have a personal net worth that helps out on this thing? Do you have good credit? So you need to know where your deal fits within those general boxes, so you can define what sort of lender you're going to approach for your deal. Tip number 2. Build your tools, build them up front, because it's about momentum. So what are your key tools for getting a financing? Number 1 for us is a CIM, which CIM is the acronym, Confidential Information Memorandum. You can think of it as your business plan or your deck. A deck is a PowerPoint presentation typically. And if you're in cannabis 3 years ago and you can get a check for anything, do up a deck. If you have a complicated story and you need lenders to understand some details, write out an old school CIM in Word and highlight and tell your story. Put in some pictures and some deck-like things as well if you want, but don't be limited to PowerPoint and 4 bullet points per page, because it doesn't communicate a story if you're in a business that needs to communicate a story. And what we're going to start doing at Sinclair Range is we're going to start doing our CIMs by video, exactly like this. In fact, I might shoot one this afternoon, and then we'll follow it up with the other tools. But the what would otherwise be the written part, I think we're going to do exactly like this by video, and I'm going to see how that goes. I'm excited about it. I think it could be cool. Second tool to think about, rolling monthly model. There's a bunch of examples with Olga Jelani on the Martinis with Scott channel. You can go check them out. This is basically your business plan projection month by month, probably for, you want to do it longer than the term of the loan that you're seeking. So if it's a 3-year term that you're locked into, the lender's going to want to see at least a 4-year plan, so they know how they get in, and then that their debt is serviced all along, and then they can get out. So you need a rolling monthly model, probably a 13-week cash flow. This is a rolling cash flow model. We have examples, I believe, on the Martinis with Scott channel. I'll double check that, and if we don't, we'll do a show on it. Appraisals. If you're going for a mortgage, you need the real estate appraised. If you're trying to buy used equipment and you want a term loan, you're probably going to have an appraisal on that. If you want asset-based lending, you need to appraise your inventory and the equipment that you're getting appraised. And the last thing to think about in terms of your tools is a field audit. This is something the lender normally organizes, but great to get a hold of the head of the curve if you can. A field auditor on an asset-based loan is someone who goes into your business and really scrubs through receivables and inventory and make sure that your accounting is doing what it's supposed to be doing. It's a complicated topic, so we'll maybe cover that in another show. All right, so number one was you figured out what box you're going to fit in with the lenders in terms of deal size, type, security, cash flow, personal guarantees. You've built all your tools. You've got your SIM deck ready. You've got your financial models. You got your appraisals lined up and ready to go. Now, you have to have a list of lenders. So you can work with an intermediary to give you a list. You can go on to all sorts of free databases. You can just Google them in your area for the type of loan that you're looking for. There's always trade finance, corporate finance associations that you can get into and look at their list. If someone calls us and they want recommendations to lenders, we give them to them free, because I don't think that the introduction is the real issue in our business. I think it's having your materials ready and a story to tell. But if you're going to market your business and you're going to raise some debt, you need to have a list, obviously, to market to. So get your list together. That would be the next tip. And get 10, 20 names together. Now, tip 3, marketing. Do you go to those 10, 20 names all at once? I say no. So if you hire an accounting firm in Canada, let's say, and similar in the US, but particularly in Canada, this is a pet peeve of mine and a pet peeve of every lender that I'm aware of, is the accounting firms will put together the SIM, they'll put together the materials, and then they'll send it out to every prospective lender that they've ever heard of, whether it fits the box or not. And so they'll rifle out 50 SIMs or 100 SIMs to different lenders. Now, why do they do that? Well, they do it is it to service the client? Is it to make sure that you have the best chance of getting money? No, it's not. I think it's for 2 reasons. One is, if you're an intermediary like Sinclair Range has been and continues to be on a limited basis, and the explanation for that, by the way, is that we've moved into a private equity model and we're buying companies as investors, and we're still providing some advice, intermediary advice, but our primary business is private equity. But if you're an accounting firm, you're in the service business, you're an intermediary, and most business brokers do the same thing. So you send out a bunch of these SIMs, and then what you're showing your database of prospective lenders who spent the time to buy a beer, go for lunch, is that you remember them and you're sending them a deal. And then they're going to call back to the accounting firm and they're going to say, well, that we don't do that type of financing. The accounting firm says, okay, just want to make sure you're on the list. So they send this, so it has to do with them and the financing source. It has nothing to do with you and your business. So that's number one. And number 2 is, if you work in a large accounting firm, what they're worried about is 2 years from now when something's gone wrong and they're in court in litigation, and the question is asked of them in front of the judge, did you canvass the market? Did you canvass the market, talk to every prospective lender that you possibly can? And they want to say yes. They want to have rifled out as many CIMs, whether they're relevant or not, to as many people as they possibly can, so they can answer that question, yes, 2 years from now. It's a big risk mitigation issue. From their perspective, does you no good whatsoever. If you're running the process or if you have influence over it, here's what we do. We have our list of 10, 15, 20 prospective lenders, and we segregate them, and we go to no more than 3. what I call a first wave. And I want to do it in waves because I want the lenders who I think are most likely to do this deal, or who I know, I want them to feel like they've got a reasonable shot at this. They're not wasting their time. I disclose who we sent the package to. I'll call up lender A and I'll say, hey, we sent this to lender B and to lender C, and here's why I sent it to them. And if you have something to tell me about lender B or C, I'm happy to listen to that on behalf of my client. But you're in a 3-horse race. Now, from my perspective, I've looked at what box we fit into, I've put my materials together, and I think I'm going to get this deal done, and I send it to the top 3. This has never happened, but what goes through my mind is, what if I got it wrong? What if I'm not in that box? What if the lenders don't see the deal the way I see the deal? What if my packages suck and I just can't get this deal done with it? Well, I'd rather know that with 3 lenders having seen the deal than with my entire 20 lender database, right? So what I could do is, theoretically, I could adjust based on the feedback from the first 3 lenders. And I could say, great, I understand you're out. And then I could just circle back with my client. I could, or with my business, and I could redo my packages, and I could think about this thing differently, the way that lenders think about this differently. And the lenders taught me the first 3, and I could go to the next wave, right? So that's the way I do it. I think sending it out to everybody at once is stupid. It's not geared towards your business. It's geared towards the intermediary themselves. And so why does that make any sense for you? This never happens to me, by the way, because what I also do with my intermediary hat on is I call the lender in advance and I say, hey, I'm thinking about taking on this client. Here's a general profile. What do you think? Would you be interested in that sort of deal? And I get some feedback. And so before I've even accepted the engagement letter, I have a general idea where we're going with these things. So I've preempted that. But from your perspective, don't send it to everybody at once. It just makes no sense. All right, so that was tip, where am I at? 1, 2, 3. So first was know what your lenders do and what box you fit into, build your tools, get your list of lenders, send them the information, market to them, keep the momentum going, obviously, as part of that marketing process. Now, you get some term sheets in. How do you select? Google them. Get an idea for their reputation, because there's great marketing machines out there that don't close deals, that have terrible post lending reputations. You might as well know that. So dig in. It's not very hard. Get some reputational public information if you can. I always look at availability. As a driver, I don't look at cost of funds so much. But if you're a business and you're growing, or you're troubled and you're trying to turn around, access to capital is key. If you have, let's say you have a term sheet that gives you $3 million of capital at an expensive, 13%, because you're a high risk turnaround, okay? Or you have another one that gives you $2 million of capital at 8%, right? There's a big delta on the interest rate, big delta on the cost of funds. I lean heavily towards availability. And the reason is because although 13% or 5% increment sounds like a lot, it's a hell of a lot cheaper than equity, right? And nobody ever thinks about that. But the dilution on the equity is crazy. The cost of funds is a lot more. You're not borrowing, in that example I gave you, that turnaround. It's like a bridge loan. It's got a shorter term. And so you can reduce your cost of funds once you turn around, but you need the availability. So always focus on that. So reputation, availability, look at your all-in costs. Your interest rate is not it. There's facility fees, there's transactional fees, right? It might cost $10,000 to do an operating line and $100,000 in legals to do an ABL. You need to think about those things based on your deal size. You look at terms. Is the lender going to try and lock you in for 3 years? Is it a 6-month bridge? Is it open? You want to think about that, and that's how you select. And if you go through a term sheet process with more than one lender, you get to negotiate the lenders off each other. That is a financing process, as far as I'm concerned. Good luck to you. Have any questions, let me know. Thank you for watching Martinis with Scott. We are a show about winning at business, geared towards management, directors, shareholders, investors. We are on YouTube, on the Martinis with Scott channel. Please check it out, subscribe. Also on Apple Podcasts, Spotify. Have a great day.